What's up, guys? Today I'll be talking about capital gains and capital losses whenever you sell a stock and how you can calculate what your tax bill would be. I've divided my presentation into three sections. They are capital gains, dividend income, and net capital loss. Let me briefly explain about what capital gains and capital losses are, and whether it's short-term or long-term. First of all, capital gains are the profits from the sale of an asset. Shares of stock, a piece of land, a business, and generally are considered taxable income. How much these gains are taxed depends a lot on how long you held the asset before selling. They are divided into two sections, short-term and long-term. Short-term capital gains tax is a tax on profits from the sale of an asset held for 1 year or less. The short-term capital gains tax rate equals your ordinary income tax rate, your tax bracket. Long-term capital gain tax is a tax on profits from the sale of an asset held for more than 1 year. The long-term capital gains tax rate is 0%, 15%, or 20% depending on your taxable income and filing status. They are generally lower than short-term capital gains tax rates. Dividends are included in income when it is actually received. They are divided into two sections, qualified and non-qualified. Qualified dividends are dividends paid by a U.S. corporation and the corresponding stocks that should have been held for more than 60 days during the 120 period beginning 60 days before the ex-dividend date. Qualified dividend tax rate is almost 50%. Non-qualified dividends are dividends paid by a U.S. corporation and the corresponding stocks that should have been held for less than 60 days. Regarding net capital loss, first, realized capital losses from stocks can be used to reduce your tax bill. Second, you can use capital losses to offset capital gains during a taxable year, allowing you to remove some income from your tax return. Finally, if you don't have capital gains to offset the capital loss, you can use a capital loss as an offset to ordinary income up to $3,000 per year. Here we have a big box and it is divided into 4 different categories. They are long-term gain, long-term loss, short-term gain, and short-term loss. Let me give you an example so that you can understand how this works, and then we'll go more into some things that you need to know and some things that you need to make sure that you do not do if you want to maximize your tax savings when tax time comes around. Case number 1. If you purchase and sell Apple stock, making $1,000 gain in 2020, but you purchase and sell Boeing stock, making $4,000 losses in 2020. So, you have a plus $1,000 short-term gains and a negative $4,000 short-term loss throughout the year 2020. So, negative $4,000 plus $1,000 means that we're going to cross out this. Therefore, we get a short-term loss of negative $3,000. Before I go further, based on the tax brackets as shown in the image here, you will be taxed at different rate depending on how much money you make. So anything that is short-term is going to be taxed at your marginal tax rate, and anything that is long-term is going to be taxed at a reduced tax rate. In terms of long-term gains is if you make less than $80,000 a year based on 2020. Then you would pay 0% in taxes on this gain. Case number 2. Now let's say, in addition to case number 1, you sell Amazon stock that was purchased 3 years ago, making $3,000 gains. You have $3,000 of long-term gains. You've actually canceled it out by realizing long-term gains. So, what that means is now I basically crossed that out. Short-term losses and gains subtract from each other first, and then the long-term losses and gains, you add those together, but then long-term and short-term losses can be used to offset one another. Case number 3. Let's say that we have a short-term loss of $0 and we have a short-term gain of $5,000. And this $5,000 will be taxed at our marginal tax rate, which could be high as 37% depending on how much money you make. However, by realizing this negative $5,000 long-term losses, we can offset the positive $5,000 short-term gain we have. resulting in a tax savings of how we would have paid on this short-term gain. Consequently, you can redeploy this money that was in a losing stock into a better opportunity. Here we have the chart that shows my stock portfolio as of September 4th, 2020. I started purchasing stock from May 20th, and mostly I have short-term loss, so I expect to have almost no tax bill for this year. Today, I've discussed about capital gains, dividend income, and net capital loss. Next time, what I'm going to do is to discuss about market bubble comparing dot-com bubble and current situations. Hope you guys enjoyed today's video, and you're gonna show me some love by smashing thumbs up button and leave me a comment down there on your opinions. See ya!